Anyway, welcome back to the Emerald Financial Group podcast. I'm here with my friend and colleague, Karo Cornips. Karo.
Hello, welcome. Thank you very much for having me.
It's good to have you on.
It's been a while. It's been a hot minute.
It has. It's been a few episodes, and I believe there was one that we actually did record together.
The Black episode.
Yep. So
it wasn't released.
Yeah. Subscribe to our Patreon if you want to see that one.
Yeah, or our OnlyFans.
Yep. So guys, we come to you after an extremely large and extremely bullish move in stock markets. Trump might say, it was up bigly. That was a phrase that he coined. Man had a turn of phrase, The
modern bard, if you will.
Yep, the modern Shakespeare. It's been a very strong move higher. We had another big rise today, big rise in the US overnight, and we're actually within striking distance of our all-time high, less than 4% away.
Yeah, it's getting crazy, isn't it? Like, I'm very much in the camp of this market's really kind of overdone. I was saying that for the past, 2 weeks. Mm-hmm. The run that we've had's got to be the best run that we've had since the COVID crash.
Yep.
Like that initial burst higher that we saw, because the duration of the run is quite long. It's really long, but the steepness of the gradient of it is really steep. Mm-hmm. And that doesn't last. The last time we had a good run was back in August, if you remember. Mm-hmm. And this didn't last that long, and this wasn't as steep. And recoveries act like this, but we have to see some profit taking coming soon. Mm-hmm. I don't care what Powell or CPI data or what, there's got to be some people coming in and taking some profits soon. I don't think there's much more this market could possibly deliver in the short term without some kind of pullback.
Yeah, I don't disagree with that at all. Markets have accelerated a fair way above their uptrend lines, particularly here in Australia.
Yep.
We've been rallying since, I believe, right around the 3rd of October, it was.
Pretty crazy.
Which was the smaller than expected rate rise from our RBA. We had that massive 3% day, maybe a bit more.
Yeah. What's his name? Low coming in unexpectedly.
Not so hot.
Yeah, and just being proactive for once,
mm-hmm.
which
absolutely.
is weird.
I think he recognizes the greater degree of interest rate sensitivity in the domestic Australian market compared to the US market.
Yeah, absolutely. It's just not within their usual modus operandi to be proactive.
No.
They're very slow to react typically.
The other possibility is that he'd been reading too many Christopher Joy articles in the AFR and or Livewire.
Yeah, there's only so many times that your enemy can say that they were right before you kind of start going,
Yeah. And if you don't believe Christopher Joy is right, just read one of his articles. He'll tell you himself.
He'll tell you how exactly right he was. Yeah.
It's been a good time. Markets are convinced that inflation is peaking and that interest rates will soon peak as a result, and that's why they're rallying. But I do get the sense that it'll be a bit of buy the rumor, sell the fact. They'll have fully priced in the peak, and by the time we get there and we start looking potentially towards the drop, which is, not just a metaphorical drop in the stock market, but also a drop in the real economy. People might start to question the prices that they're paying.
That's a really broad conversation about inflation, who's caused it, why they've caused it, and who's paying for it. And I get pretty militant about it. So unless we want to be here for an hour, we should table that one for another day. But I think that ultimately, if we're just talking about the short term, I think we're due for a pullback. But in the longer term, I think things are still up in the air because retail sales in Australia came in pretty bad. I think they were expecting 0.6 and they came in -1. Mm-hmm. And people need to remember that people buying stuff is the economy. Yeah, that's ultimately the biggest
consumption is the biggest part of the economy.
And we're heading into Christmas. I know it's seasonally adjusted, but you don't want to see negative retail numbers going into the holiday period. You don't want to see that. And so we're already starting to see kind of those cracks, right? The tremors, if you will. The market's a curious thing. It's always forward looking. I hate the term priced in because it's interest rates are priced in. So what about the recession that's coming next year? Oh, that's priced in. Oh, so they're pricing in the recovery. Oh, well, that's priced in. But then the recession after the recovery, that's after the recession, is that priced in as well? Is the heat death of the universe priced in? Like everything's priced in, right? So my point is that I don't really like that as an excuse. I think ultimately...
No, and just to sort of interject there, if everything was priced in, markets would never move. They'd make their one move and then they'd never move again after that.
But people dip to that well. They're so easy just to, they go, oh, well, it's priced in, you know? Like
No, but I do think that in this scenario, and I go back to the phrase that I said, it is a bit of buy the rumour, sell the fact. Everyone's saying, well... You know, the good time for markets will be when this interest rate rise cycle ends. And so they're trying to get in ahead of that.
Yeah.
And by the time it does end, maybe everyone's already gotten in. Maybe all the good time has happened. And, you know, it'll be a buy the rumour, sell the fact scenario.
Yeah, I think we're very much on a similar page. I think that the rally that we're seeing is inflated. I think they're setting everything up to knock them down. The US has hit its downtrend line. So we've got to see how it plays out there. The reason why I'm harping on this is because it's not really the US that's run too hot. It's our market. Mm-hmm. Our markets are completely disconnected, and our market doesn't disconnect from the US for too long.
No.
If you're an investor, the market disconnects for a blink of an eye. For a trader, this is a stupidly long time it's disconnected. Mm-hmm. The best argument that I heard that you made the other day was that we're actually tracking value stocks in the US. And that's the best argument I've heard for why this market can stay elevated. But CBA's like $1 off its all-time high or something, like $2 or whatever it is, right? Something stupid. Whilst we're heading into recession.
Yes.
You know?
And I think that there's a couple of reasons there. And I think, you know, everyone is expecting dramatic improvement in banking profitability at higher interest rates.
Yep.
And you'll have much higher lending spreads and things like that.
Yep.
But as you're alluding to, I don't think it adequately reflects the risk in the housing market.
Exactly. Well, 100%.
You know, yeah, well... from the very first place, from the declining home values, which will lead to declining loan values, which will lead to declining volumes of mortgages. And then going beyond that, you know, the potential for bad and doubtful debts, the potential for loan impairments and things like that may eat into profitability.
Yeah.
So I agree with you that I don't think that's fully captured in CBA's price.
Just in the short term, right? I mean, I'm not going to argue medium or longer term too much, but this just feels... what's the word? Not real. It doesn't. It doesn't feel like there's anything of substance driving the market at the moment. I think that it's via the reactionary.
Hopium, perhaps.
A bit of hopium, yeah. I think it's a bit of manipulation. I think I think they kind of keeping that this last leg higher. I would not be surprised because it's very often that as markets hit all-time highs, they go that little bit more just to kind of get more people in. And then it dumps.
Yeah.
Right?
A blow off, some people might call it, or a fake out.
Yeah. Very common here in Australia. No other, like a lot of cars, I think that, so it's not necessarily does CBA, you know, how's it going to function in a recession? I mean, value stocks are going to do better in these types of environments. You and I were saying this like a year ago. Mm-hmm. I remember we were talking about
absolutely.
how value had to be the way it was.
You can go watch all our previous podcasts if you have. You know, we've rambled on ad nauseum value stocks, material stocks, low PEs, high yields.
That's it.
In a higher rate environment, as we've been saying, you want to be holding stocks that are priced presently, not priced on future results.
Yeah, exactly. And that's like a lot of our big market, right? Mm-hmm. That's, you know, the financials make up 30%, and the banks, the materials make up 25 or something. So over half the market is dominated by a handful of companies, really, and they're all like incumbent value stocks.
Yep.
You know. So that's the majority of our market. And so our market's always going to do better in this type of environment. But at the same time, like, again, you know, this run just feels like you need a pullback. You know me, I've been buying shorts and puts, and that's kind of the only thing I've been doing the last few weeks.
Yep, absolutely. And look, I don't disagree with you at all. One thing that, you know, I always like, I've got my phrases on the market, and if you call up and have a chat with me, you'll probably hear me sort of espouse them from time to time. You know, things always go on a lot longer, a lot further than you initially think they will. I think who was it? One of the famous investors of years past once said that the market can remain irrational for longer than you can remain solvent.
Yeah, Wayne Gretzky said that.
I don't think it was Wayne Gretzky. I think it was Jesse Livermore.
Yeah, right.
God, I'm out of date with my my quotes.
But yeah, the idea is that, and that's why I think you have that last leg up, and I think you might be seeing that now. But we've got other price data coming out tonight or tomorrow night.
PCE price data tonight. We've got US unemployment data tomorrow.
Yeah,
I think that's going to be very
one
big.
thing that you're going to have to keep an eye on for sure.
Next week you've got our Reserve Bank meeting on Tuesday. They'll probably do a 0.25% rate rise.
That's what's expected.
That's what's expected. Excuse me.
Could you imagine if could you imagine if he doesn't?
Jerome
Powell, they just look, we're actually not going to raise rates. What we're going to do is monitor the situation. And could you imagine if that would just, the market wouldn't even care. Like it'd just buy, it'd be on for young and old.
We always joke about, them being very unprofessional in their statements and things like that, and coming out and saying something like, the rally's back on, lads.
Yes.
Load up.
just buy calls.
Guys, we just plugged it in. The printer is running. RBA next Tuesday. That'll be followed the following week by, I think, the biggest events this month. And that'll be not Christmas, but the CPI data on the 13th.
Yep.
And then the Federal Reserve meeting on the 13th and 14th. If you look at the FedWatch tool, about 3/4 or 75% chance of a 50 basis point rise from the Fed on the 14th, which is a slowing in the rate rises.
That's what they were hoping for.
And that's what a lot of this current move up, I think, has been sort of driven on the back of. And then the next meeting after that is in February next year. And it's about 50-50 whether they do 50 points here, 50 points there, or 50 points here and just 25 points there.
Yeah, I think I think it's going to be data driven. Fed's been pretty clear on that.
Yeah.
It's either that or they're just kind of doing, it's the Wild West and they're just like entering positions before they say random stuff. I don't know. But yeah, it's got to be data driven.
Yeah, it's got to be data driven. And I mean, even if they do slow, they're pretty adamant that they are going to keep rising, a lot longer and a lot harder than people think, and that you shouldn't expect a rate cut next year. Now, markets continue to price in a peak in interest rates, in the first quarter of next year or towards the end of the first quarter next year.
Yeah.
And that rates will come down soon after.
It's probably right, though. I mean,
it is, but is it the market forecasting, or are they calling the bluff of the Fed?
I think so. I think it's both. I think the market's forecasting, they're calling the bluff of the Fed, and I think the Fed's going to listen to it a little bit.
Yeah,
because
there's a few things.
I can't imagine. Yeah,
a few opinions I have on this, and the first is that no one is particularly good at predicting when rates will top out and when the reverse will occur. Not economists, not speculators, not the Fed themselves. Even the people who set policy actually don't, if you look at the dot plots and whatnot, they don't well predict their progression on policy moving forwards. They're actually pretty bad at it. And I guess the second thing I wanted to say was that even if the Fed does believe they're going to shift at that point, they don't want to say it because they think that means everyone will again move into this exuberance phase.
Yeah, because
they'll take out big loans. They'll start spending again. My commitments are going to come down next year.
Yeah. It's this idea of sentiment that actually leads things, not necessarily the rate change.
And realistically, that's all the Fed has is sentiment.
Yeah, the power of the pen.
Yeah.
It's arguably more powerful than the change of the interest rate itself, right? But yeah, I can't imagine that. They I reckon.
I feel we're getting a little bit off track, and I feel perhaps should return to the track and maybe sort of set camp for the night.
Was that too heavy?
It wasn't too heavy. It's just, it would probably either people have turned off to another video, or they're sort of now watching for the wrong reasons.
If you stayed up to this part, you're a champ. I appreciate it.
If you have stayed up to this part, let us know in the comments.
Yeah,
we'll give you a shout out next episode. But yeah, to get back to where we were, look, obviously markets extremely enthused in the short term. They've been grinding strongly higher. It does look very much overdone.
Yeah.
But you know, if you watched our podcast from a few months ago, we were telling you that this run in value stocks was the way to play it.
Yeah.
To avoid the growth stocks, and that's how things have shaped out.
And they're still good during recessions.
Yeah.
To be clear.
But in the short term, I think prices are looking a bit expensive. You know, you're talking about CBA trading 18 PE versus a global banking average of 12, if that. There's a lot of things on our market that are looking. Some of these iron ore miners are trading at levels when iron ore was at 200 a ton US. It's now around 100 a ton US. Costs have gone up. Production hasn't been that great. Prices do look a bit overdone in the short term, and fortnight, maybe 2 podcasts away, maybe we'll be talking about a slightly lower market.
Yeah, I mean, I just want some mean reversion, right? Is that so much to ask for? I just a pullback to the average would be logical, right? Do you know what I mean? Even back to the trend line. I mean, I'm not asking for the world to end, but just some profit taking so I can make sense of this all. You know what I mean?
Absolutely.
Like the more it runs, the more I feel like I'm taking crazy pills. Do you know what I mean? Like, what's going on? So yeah, I want to feel like my brain's in working order again, and I can. Unfortunately, that's tied to the market falling at the moment.
Absolutely. So yeah, the market is the great humbler, and it's always right.
Yeah, I'm the most humble person you'll ever meet.
And look at what it's done to you.
Yeah, the most. There's no one more modest or humble than me.
I think we'll probably end it on that note. Me and the humble king over here. I hope you guys really enjoyed this episode. If you did, let us know down below. Give us a like, click that subscribe button, and we'll hopefully see you in the next one.
Thanks, guys.